I'm going to ask Don, Greg, and JP to turn on their videos and their microphones. Don and Greg, we don't see you yet. There's Don, so please turn on your videos.
My system says the host has asked you to start your video. I said, okay, and it seems to be working. There we go.
Yes, Kim may need to just give you permission, but there you go. So just as context for this next segment, what we just heard about was real-world asset tokenization, and we heard the sort of institutional end of that story from Graham Archax and from the UK. And we already have spoken today about the tokenization of dollars, stable coins, which is doing several $1 trillion worth of volume today and is surpassing Visa and MasterCard. We heard about use cases, for example, in Africa from Yellow Card. We then heard about tokenization of money market funds, and we know there's several $1 billion worth of those that have already been issued, and BlackRock and Biddle and Securitize is an example of that. Now we're going to talk about what comes next. And as investors, we should always be looking for the next $1 trillion opportunity. And I think that we are going to go straight into that in this next segment. So I encourage you to pay a lot of attention in the next 30 minutes or so, because I think we're going to talk about two multi-trillion-dollar opportunities. So before I launch into the first question, I'm going to ask the folks to introduce themselves in the order that they're on my screen. So Greg, if you could go first, please, and do a brief introduction of yourself and your background.
Hi, I'm Greg Kidd. I'm the owner of Vast Bank, which is a OCC nationally chartered Fed holding company, but have a background in crypto and also at the Federal Reserve, and have been a leading proponent of tokenized deposits.
Thank you, Greg. Always modest. Greg also was first money in on Twitter and Square, and was perhaps one of the first, if not the first investor in Coinbase. Was one of the largest holders of Ripple and Solana and other things. So Greg, I can't let you get away quite so easily with now, Don, you also have a long and successful history in financial services. So a quick introduction from you, Don.
Sure. I'm kind of the old man in the normal from the real world here. My history has two big elements to it. One is as an investment banker to the investment management world, where we were the leading investment bank for 20 some odd years. But really my love is systematic investing and quantitative activities. I involved in the creation of the first index fund, the first ETF, things along that line. So innovation in financial services, which is why I'm here.
Yeah, and Don also is too modest. So he was in at the beginning of the creation of iShares. Allison incubated it at BlackRock. I was involved in its formation. Today, there's $4 trillion sitting on top of that innovation, iShares, and Don was very involved with that right from the very beginning. And JP, quick introduction.
Thieriot, co-founder and ex-CEO of Uphold, and still a board member.
Thanks a lot, JP. So actually, I'm going to split this panel sort of into two parts, because we're going to cover off two very different topics. And because of that, I'm going to ask JP and Don to be a little bit patient, because I'm going to start with Greg. We at Blockchain Co-Investors, through actually Blockchain Capital, who's coming up next, Bart and Brad, we were very lucky to become equity investors in Tether. And through DCG, we're equity investors in Circle. And I think everyone on this call probably appreciates that those are the world's two leading stable coins. And today, they are very valuable companies. And they, between them, do trillions and trillions of dollars of movement of money. But they're fundamentally flawed. And Greg, what I'd like you to start off is telling us how you plan to make the world's best tokenized dollar and what would be the attributes that would make it better than Tether and Circle.
Well, yeah, I don't want to suggest that stablecoins are flawed, and we're big supporters of them too, but they run on great rails that run 24/7, run globally, and run and support the US dollar. All that's terrific. Our just observation would be that once those stablecoins are issued, they can move around without identity, and therefore, without identity, those tokens aren't going to be FDIC insured. They're not going to have Reg E, which is chargeback protections. They won't have consumer protections. And so they're sort of dollars in the wild. And some people want dollars in the wild, but you could use the same innovations of blockchain to allow things to run 24/7 for basically no cost, and you could do it with identity as well. And so we're simply suggesting that the legacy industry of banking, through tokenizing their deposits, could have a parallel innovation to stablecoins that have identity. And we think that that might actually be the bigger market share for all the transactions that need to be compliant versus stablecoins, which might be compliant, but they might not be, but it's hard to tell because there's no identity involved in moving money on blockchain when you have a stablecoin.
Thank you, Greg. So obviously for the audience, some people are hearing this for the first time. So what would a dollar-backed coin or token with identity, how would that function? How would it be created? Who would issue it? I know that you have a plan, so can you just explain what that looks like?
So just everybody knows, anyone could be a dog on the internet. To prevent that, you'd actually say that you couldn't hold this token without credentials that point to your identity. It could be round tripping your mobile phone number, your government ID, proof that you're already connected to another regulated financial institution. But just like there's a namespace for the internet, everybody would have a name. You can think of it as your handle, and you send money from one handle to another, and all of those point back to a real world identity. And so you cannot hold a deposit token without an identity, whereas you can hold a stable coin without an identity. All you need is a private key. It's a bearer bond. That would not be the case if you're dealing with tokenized deposits. And those tokenized deposits would be issued directly by the banking system, not by an intermediary like Tether or Circle.
Okay, and it has a name, I think, Greg. I've read your white paper. This is
we have one that's just USBC, just like USDC is one of a stable coin, but it's not meant to be the only deposit token. It is an example of a deposit token, just like USDC is an example of a stable coin.
Right. So if you had a identity backed a token that had identity in at the beginning, and you've already explained that would ensure that you had provenance of who had issued the token, who's holding the token, what the token's being used for. And obviously you've already said that in some places around the world, in some use cases, that would be very important. Who would issue these tokens?
So we're suggesting for a US dollar, the only folks that can actually issue a real US dollar is a US bank. They're the only ones that have access to Fed master accounts. And so I'm just contrasting that kind of dollar, which is versus something that people might be familiar with, which is a euro dollar, which is some non-US bank issuing something. And then you have to hope or believe that that dollar is ultimately backed. And so in the case of a true US dollar issued by a US bank, they're the only ones with access to the Fed discount window. They're the only ones with access to the payment rails. They have FDIC insurance. So it's just if you will, it's a more I don't want to call it a better dollar, but it's a true bank dollar as opposed to something that's a derivative and is one step removed.
Okay, thanks, Greg. And so last question, and then it's not the last question for this panel, but the last question on this topic before I move on to another topic. If you had what you just described, and I know you're working hard to create it and build it and launch it, how would that work alongside or a Tether and a Circle? So Tether and so like I was with Paolo in New York last week. Paolo is the CEO of Tether. He mentioned he's already got 400 million people using Tether. They're doing about 15 trillion of transaction volume. When and how would a USBC work alongside or in place of Tether? How would you imagine that shaking out?
Well, USBC and deposit token should play in the same sandbox as coins like Tether and USDC, and the big market makers that basically move between those probably at par, because there'd be folks like us that would encourage it to be at par. It's just that you can't, for instance, have your paycheck deposited into Tether. Tether doesn't have a bank account number. USBC would have a bank account number, and so it could have dual use. It could be used either in the traditional banking system, whether that's for bill pay or getting your paycheck deposited, but it could also work in the crypto world. So you could send it to an address just like USDC and Tether. It's just that that address would also have an identity attached to it, or else you couldn't do the transaction. And so they're interchangeable, except we're just looking for deposit tokens to be used in situations. Just imagine a retailer like maybe Walmart doesn't care that $3 billion come in from unidentified wallets, but some regulator or law enforcement might. And so they may be more amenable to having large payment volumes, retail payments, wholesale payments come in from wallets that are identified rather than wallets that are pseudo-anonymous.
Right, thanks, Greg. And so, in a way, this solves a big question we're hearing a lot in the banking industry. Here in America alone, we have about 3,500 banks. I think there's no bank that isn't right now, somewhat late in the day, taking a look at stable coins and saying, what do they mean in our industry and in our business? The largest banks in the world may even have teams building their own stable coins, but most of the 3,500 don't have that ability, and you are a solution for every other bank.
Yeah, every bank in this solution, every bank could just join in the consortium. Every dollar issued out there would be spread across all the banks in the consortium. There'd be ideally one tokenized deposit as opposed to a bunch of little silos. In the 19th century, each bank used to issue its own money. Then the Federal Reserve came along, one currency, all the banks distributed it. This is more like that reality than a world where there's JP Morgan coin versus Wells Fargo coin. We suggest there should just be deposit tokens, and the banks can bid for how much of the deposit token base they want to support, but we shouldn't end up with a bunch of siloed deposit tokens. And that's one of the challenges for stable coins too, is there really room in the market for 100 different stable coins, or is it going to be kind of a winner take all situation?
Yeah, great. And for those people who are listening in, mostly wealth advisors, family offices, and so on, just to put a sharp point to this is exactly the same discussion that led in the first instance to the creation of Visa and MasterCard. Once the banks really got their heads around the need for digital payments, eventually Bank America was encouraged to spin out Visa and turn it into a bank-owned consortium, and the rest is history. And I think all Greg is really saying is that USBC and bank tokens have the opportunity to do the same thing for the entire banking industry globally.
That's exactly correct.
Yes. Yeah. Thanks, Greg. So, Greg, I'll come back to you before the end, but now I want to shift. So this is a real pivot, because now we're talking about the same technology, but we're going to apply it to one of the world's largest and least digitalized spaces in which value changes hands, and that's the global energy markets. And JP and Don have put their heads together for a long time now. JP actually, I know, has worked on the notion of digitalized carbon credits for several years, 5-6 years. Now they want to describe something that I think is as equally big an idea. And so I actually don't know which of the two of you wants to lead off by describing the opportunity in the space. JP's got his finger up.
Only because I think Don should speak to the meat of it, but it occurred to me that there's an interesting way to tie together the end of Graham's discussion with Greg's before getting there, and that is just maybe a little bit from the Uphold perspective. So as a general theme, there's this transition from what has been a world dominated by sort of degenerate speculation to one wherein I think DeFi is on the cusp of delivering real world utility. And an example of that is a deal that Uphold recently cut with a company called Exactly Protocol, which can issue essentially a crypto-backed credit card in 160 countries, where somebody puts in some crypto, they immediately get 50% LTV, and they're paying an 8% interest rate as opposed to what they'd be paying in the conventional sense in the US. So to the end of the Graham discussion, there is DeFi delivering something in an incredibly sexy way for the first time. And so you're seeing, there was the question around centralized businesses doing or engaging with DeFi projects. You saw Coinbase do Morpho. You saw Binance tie up with MetaMask, and I think Uphold hopefully has leapfrogged all that in a consumer sense with Exactly. To tie it all the way back to Greg, the regulatory, the compliance side of that crypto-backed credit card is very clear. On the card side, we do liveness tests, compliance, et cetera. But on the lending protocol side, it gets more complicated because these are DeFi lending protocols. And whereas a USDC has that compliance at issuance, to Greg's point, once it's out there in the wild, you lose track of it. And so the regulators debate this thing called the dollar standard, in the sense that the dollar has an almost, global monopoly on involvement in crime. Yet the issuer of the dollar is not responsible for the fact that it's used in a drug trade. That standard is something that is relevant to the distinctions between a Tether, a USDC, and what Greg is talking about. And where the regulators would be dissatisfied with, hey, it's USDC, that's good enough for us. We would try to hold them to a dollar standard. USBC would be sort of like the carpool lane versus the other lanes on the freeway. It would just go faster. We'd have no problems. Hey, there's a lending pool. It's using USBC, no issues with the regulators. So that was my sort of transition, tying those two things together. That was more answering the question that was asked at the end of Graham's thing. And now on the totally other side of crypto, from utility and DeFi and these sorts of things, is what is being tokenized. And stable coins are obviously all aimed at FX, which is the single most traded thing in the world. The next most traded thing in the world is oil. And at Uphold, back when we were Bit Reserve, we took a crack at it and immediately ran into a lot of impossibilities around doing it. It is interesting that, being the second most traded thing in the world, there is no retail accessible spot product out there, which is interesting and different from, say, gold. And with that, I'll transition over to Don, who I think has cracked this nut.
Well, actually, I'm going to take a step back and just say that the through line of all of this is a distinction between FX transactions, deposit return in the form of yield. And I agree with Graham, and I agree with Greg. The name of the game in making that transition is from instantaneous utility to utility over time. Yield is not just a number; it's a number with a time component to it. And that's moving us toward the world of investing. And the world of investing is a long-term game of capturing return streams. And by the way, just to put some numbers around this, the ETF world started in 2004-ish. Here we are 20 years later. ETFs hit 15.5 trillion at the end of last month. Mutual funds, from which they stole all their share, are about another 10 trillion. So we're talking a $25 trillion TAM if you can move the blockchain into the world of investing, capturing return streams for investors over the horizon of investing. And when you talk about capturing return streams, of course, you have to capture the ones that everybody cares about, which means there has to be an unmet need. I agree with what Graham said at the end of his comment that, look, we're headed toward the S&P 500, we're headed toward portfolios. I don't personally think we're headed for individual illiquid securities. That's a swamp people have been lost in. It's a La Brea tar pit, and the bones keep popping up. But I think when you talk about oil and you talk about energy, and I try not to talk about oil, I try to talk about energy. Energy is one of those return stream primitives. It is a crucial component of any kind of forecasting for any kind of economy, for any kind of global exercise. And it happens to be a return stream that's very hard to capture unless you are willing to pay the price of a derivatives manager, get into a derivatives portfolio. And even if you do that, some pretty weird stuff happens. May 20th of 2020, the price of energy went to negative $37, which is a little counterintuitive. Now, it was 10 days before the close of the futures period. It had a lot of special sits. But the bottom line is the poor sons of guns who owned the only oil mutual fund, that mutual fund collapsed. Oil price tracking obliterated them. They had to do an 80-to-1 reverse merger or reverse issuance to get back. And that just illustrates both the risks and the challenges of oil. And what we're striving to do here, without going into the sort of secret sauce stuff, which I think nobody really cares about, is to bring to the marketplace a fungible oil energy exposure British thermal unit coin that can be used both as a return stream generator and ideally in the long run as a alternative source of transfer of value, both within the industry and outside the industry. And of course, it's a very large marketplace, which means we're very aspirational and thinking about even making a small movement in it.
Okay, so Don, I think what I heard was, one of the world's largest industries, the energy industry, hasn't been the beneficiary of things like you're describing, digitalized, tokenized, real-world backed tokens. And the idea here would be to have an energy unit backing a token so everyone in the world could use it. Now, ideas are easy to come by. It's very hard to gain traction, especially in well-established markets. So can you give us a sense of what specifically would have all of us listening to you, why should we believe that this is going to happen and that it's real?
Well, I think there are three legs on which this stands. One is a simple observation that in the asset allocation portfolios that dominate the investing world, energy and the return streams associated with it is captured indirectly and poorly. And it's a powerful diversifier. It has a volatility, spot prices have a volatility of about 24% per year, 24 vol, as we would say, and they are uncorrelated to most other major return streams. So it's a missing piece of the portfolio. Now, there are other missing pieces and no one cares. So you have to move from that to some of the advantages, the second and third leg. And the second leg of this is that it is fractionalized and free. The arithmetic, the ETFs didn't just win because they were a better mousetrap. They won in part because they were a cheaper, more efficient mousetrap, more transparent, more straightforward, and easier to use in both a tax and administrative sense. And leaving aside the administrative aspects, which are not trivial with the blockchain, we see very significant advantages in terms of ease of access, ease of holding, and investors are holders, not traders generally. So that's an important incremental advantage that we think justifies the use case. The third thing, which is actually not trivial, is that in competition with existing futures portfolios, for people who are trying to hedge, hedging in futures and derivatives is a complex, expensive business. Now, you can debate whether you want to be long or short, and you can debate the time periods. But today, there is no way to anchor your hedging portfolio with a simple, cheap, easy to hold long exposure. And so our sort of lowest hanging fruit is just a better way to hedge. The next highest piece of fruit is fractionalized access by the retail world. And then the hardest to get to, because they're stuck in their ways, is large institutional portfolios that are underexposed to this. And I would make one other comment, which is in the asset-backed token world, the threshold for profitability is low enough that you don't need massive use case. ETFs had enormous embedded costs, and they had to grow. I think they lost money, Matt, you would know better than I do. I think they lost money for 11 years, 12 years before BGI started to record serious profits. And that investment is no longer necessary because there's been so much groundwork laid for looking at this type of token.
Okay, thanks, Don. So we've just got a few minutes left, and I want to give all of you a chance to wrap up. So the reason we featured these two ideas, bank tokens backed by dollars and oil-backed tokens, is because both of these ideas are as big as Tether. In their own way, they are as big or bigger than Tether. And if there's any investor on this line that questions whether they should be an investor in Tether, let me simply say that they are by far the most profitable company in the world based upon their margins per employee and so on. So these two ideas appear very large ideas to us. Greg, I mean, there's an investor community listening in. Is this something they can invest in? I know I'm putting you on the spot, but it's what, you have had quite a track record of success in the past, and you're also involved in Ripple XRP early on. How can people participate in USBC?
Right now they can't, but very soon, we hope by this summer, there'll be a public company vehicle, just like there's a public company vehicle for Visa and MasterCard, and that'll be a vehicle that the public can invest in. And so that's the mechanism there. It like Visa doesn't own the banks. It doesn't own many of the puzzle pieces. It's the scheme, and we'll put that scheme out there for people to participate in.
Okay, thanks, Greg. And Don and JP, I mean, we're not soliciting for anything on this webinar, but is yours an open opportunity? Is it a Web3 tokenized project? Is it an equity-based startup? What are you building?
So we'll be doing an A round soon in the coming months, and there will be a token issuance within a year after that.
I would make one other comment, though, and this goes to Greg's point. For true global utilities like Visa, MasterCard, et cetera, the very best structure is a hybrid structure, a combination of consortium structure and public participation. And while this is a ways away, that's very much in the crosshairs of how we look at 27 and 28 financing.
Great, thank you. So I'm actually going to wrap this one up now. We're nearly at the 11:30 mark. JP, Don, and Greg, we're fortunate to have peeked under the hood of both of these ideas and know just how big they are. For the audience, it may have felt a little bit in the future, but these are multi-trillion-dollar opportunities, and we wanted to share them with you and let you hear it direct from Greg, Don, and JP, who are driving these respective ideas forward. So thank you very much, Greg, Don, and JP. Much appreciated.